This is the current federal tax developments for the week of March the 24th, 2025. Current federal tax developments are brought to you by your state society of CPAs. And we're going to talk this week about a number of cases and things that came up over the week. Specifically this week, we're going to talk about a report from the Treasury Inspector General for Tax Administration, TIGTA, involving IRS refund claim processing where there are deceased taxpayers, issues that have arisen with that. We're also going to talk about the IRS's certification of associated delinquent tax debt to the State Department. A taxpayer was attempting to get that undone because, they kind of ignored notices, they didn't make payments, and now suddenly they're coming back, and once they're basically, they've lost their passport, they're now coming back and trying to get some quick relief without paying off the debt. Turns out that doesn't work. Yeah, so it's one of those things. Don't ignore it, especially if you need a passport. In your business that you're doing, it could be a problem. We're going to talk about refund claim challenges from the IRS. It's a specific case involving COVID-19 period, where the IRS was telling people not to send in additional requests, a second copy of a refund claim, and not to contact them to see whether the claim had been processed. And so, as you might guess, that is a bit of a problem if the IRS in the end says they never got it. That's what happened here. The key question the court was going to look at was, was the IRS bound by the fact they had told these people not to file, to not do that, or was the fact that the law very clearly establishes the dates by which things must be filed, and they had not used certified mail in order to, prove that they had filed the document? Are they just out of luck? And unfortunately, I'm going to discover it's the second one. They're out of luck. We're going to talk about the Sixth Circuit looks at an IRA forfeiture. Taxpayer was involved in some criminal endeavors that were very profitable for the taxpayer. The taxpayer, based on that, had funded up a SEP, and in that IRA account ended up with somewhere around $450,000 sitting in the SEP account. And the taxpayer is like, okay, now that IRA account is awarded to the government as part of the criminal prosecution, part of basically the sentence, etc. And the question becomes, is the taxpayer taxable on that when the government takes that account? The IRS said, and the tax court said, yes. But the Sixth Circuit reversed and said, not in this situation. There's a subtle distinction between when it will be taxable and when it won't be taxable. We'll talk a little bit about that. Next, we're going to look at a case that arguably you might think, well, who cares about the old 199 domestic production activity deduction at this point in time? Yes, I realize there's a case here that came down, but it's like nobody currently has that. And very, very few of you probably even have an issue where there's an open year, unless you're in the middle of a DPAD case that hasn't settled yet, which was the case here. But it's more interesting because this is a case where the taxpayer was relying upon Loper-Bright, Supreme Court decision Loper-Bright, and that was really what they were basing their primary challenge, stating they should be able to get the domestic production activity deduction for software that they had developed as part of their pharmacy benefit manager program they sold to pharmacies, stating that was clearly under 199C. Software is one of those things that is considered to be production. And we'll talk about why the court said, first thing is you can't just use the magic incantation Loper-Bright. Loper-Bright didn't require everything to be skipped here. But number two, the other big problem we have with why Loper-Bright's not going to work is very simply, that even if, you have to look at how Loper-Bright's applied to specific cases. Loper-Bright does not say if you disagree with an IRS, regulation that, by the way, you can just make the magic incantation Loper-Bright if it hadn't been reviewed under Loper-Bright, and bingo, whatever position you take is going to be fine. It's not how this works. I have seen people kind of try to do Loper-Bright as this magic incantation, and it's more involved than that. Whether the court got it right is a whole different question. but it is more involved than that. So we'll get into that. And then finally, late in the week, the IRS did an update on their FAQ for the employee retention tax credit. And in this case, they came out with a simplified income tax reporting for wage reduction option. I'm going to talk a little bit about that, how that addresses the problem of out of statute years, what we can do about that. But I'll also point out that nothing in the guidance indicated it could only be used for out of statute years. So we'll talk a little bit about that as well. So with that, why don't we go ahead and let's carry on and look at this TIGTA report on the IRS processing of refund claims for deceased taxpayers. The document in question is entitled Improvements Are Required to Promptly Validate and Issue Manual Refunds Associated with Deceased Taxpayers, right? And so this is kind of the background. It is TIGTA report, in this case, 2025 IER 012, and it was issued on March 12th. Okay, so we have that background. Now, these concerns were raised by an IRS employee regarding the timeliness of processing tax refunds for a deceased taxpayer, leading to undue hardship for subscribers. And they also looked at the issue of, are they validating things correctly as well? So both problems. Okay. Now, they did note that there are significant delays in processing. The IRS took on average 444 calendar days. That is over, well over a year to process and issue decedents refunds between January 2021 and July 2024. While 35% of those refunds were issued within a year, nearly half the remaining cases took over a year. And the backlog amounted to 443 cases, nice number, with over $1.3 billion due to survivors. Okay, so we're concerned about the fact that that adds a lot of time, and slows down, and just means you got to keep things around. You got to keep things around. You got to keep things open and processing in order to receive that refund. And then we eventually have to then distribute that out to the heirs, who are all wondering why it's taking so long for the refund that dad had, that we know now is coming. Okay. Now, there were also, they discovered, questionable refund issuances. They reviewed 77 cases where the claimant selected box C, the person who claimed, I get the refund, on Form 1910. This claimant's not a surviving spouse or a court-appointed representative, and revealed that in 3/4 of those cases, the claimant's entitlement to the refund was not verified. Right? Yet, in any event, refunds were issued when information was inaccurate, incomplete, or missing. Right? It's one of those little things. There's also inconsistent guidance and procedures for rejecting incomplete Form 1310. Again, the sample of those 77 cases, 26% had errors on the 1310, such as missing or incorrect calendar or tax years, yet the refunds were still paid out, right, in those cases. And some teams processed forms with incorrect years, while others corrected the information. So it's a roll of the dice, depending on who gets you, where your refund claim goes to. We also have, in this case, a bit of an issue with interest calculations, right? 13% of the sampled manual refunds had miscalculated interest, affecting an estimated 47,542 claimants, right? It's going through a manual system. The potential for human error in manual entry is significantly higher, right? Those are kind of, because they're entering numbers for interest calculations was a major contributing factor. If you make any entry errors, then you're going to get the wrong interest, which could be overpaid or underpaid, but it is a problem. There's also limited access to documentations and unclear guidelines in this case, right? The employees who process manual refunds often lacked immediate access to necessary taxpayer documentation, leading to delays. And the process for requesting Form 1310, letter 18C, and receiving claimant responses is inadequate. Furthermore, guidelines for customer service representative and individual tax advisory specialists are unclear, often resulting in claimants being told to simply resubmit their 1310 instead of the employees taking action to obtain the form. Right? That's also in there. So based on this, we have some recommendations for changes. Right? They recommend first that require additional documentation be provided with all 1310 filings. They also recommend that there be consistent guidance provided to all employees regarding how to handle 1310, that is missing or erroneous calendar and tax year information. They want to coordinate with the appropriate IRS offices and senior officials, to expedite the approval, funding, and implementation of the programming request to reduce the need for manual refunds. And also ensure decedent refund program requests as appropriate controls to systematically calculate the accurate interest owed to survivors or claimants. And, recommendation 5, to update the internal guidance to advise individual taxpayer advisory specialists and customer service representatives to obtain a 1310 while assisting taxpayers and electronically route the documents to employees assigned to the case. And then finally, the 6th recommendation was to the IRS develop procedures to upload claimant requests using assigned employees to electronically access supporting documentation for decedent refund cases. The IRS has agreed with all 6 recommendations, and implementation of systematic refunds are expected by mid-April of this year, coming up shortly, and full electronic document workflow is expected by 2026 in the IRS's standpoint. And specifically, what is our implications for tax practitioners? Important to understand how to assist clients who have this, right? Now, probably there are fewer problems with ones that go through a tax professional, simply because we're aware of the requirement to have a 1310 to get that data in there. I think a lot of these are people that file a return, right? And, maybe attach a power of attorney, maybe attach a trust document. But whatever they do, they don't fill in the 1310 or just have nothing and write a note that says, hey, I get the refund, and nope, that's not going to work. You need to be aware of potential delays in receiving manual refunds. Remind clients that this process is going to be a problem potentially and may slow down. So don't promise the heirs that you're going to have the refund money at the same time frame that you'd get the refund if it was, just your own personal refund. That's not going to go there. Verify for sure that you're doing complete and accurate Form 1310 filings, and, scrutinize them. Our goal is to not have the IRS have to come back to us. And while I realize, TIGTA said that some cases they just don't come back and they just refund the money, I don't think you want to count on, that roll of the dice coming out in your favor. And the IRS has agreed to improve processes, so hopefully we're going to have more timely and accurate refunds in the future. Okay. Next up, Drew Pifferman versus Commissioner. This is the Passport, seriously delinquent tax debt case, right? Okay. In this case, it's Tax Court Memorandum Decision 2025-22. Now, he filed his 2018 tax returns with no tax due. The IRS determined that he had nearly $370,000 unreported income, and there was an assessment of over $143,000 of tax penalties and interest in February of 2021. There was a notice of intent to levy issued in November of 21. They never requested a collection due process hearing. Okay, now all the steps have been completed, and we have here a tax debt in excess of the limits. The notification of associated delinquent tax debt was issued in March of 2023 when the liability was $182,687. So now suddenly we have this problem. Right? Now, the petitioners sought the tax court's review under Section 7345E. Why did the taxpayer say that they should be able to review this, right? Well, first, it appears now, very late in the game, they appear to challenge the underlying tax liability, argue that it should have been paid by a third party. Okay? That's their first. They also suggested partial payments had dropped liability below the threshold. And, the tax court noted, however, that it's only got a limited basically scope of review. It doesn't have the jurisdiction to review the underlying tax liabilities in these proceedings, trying to get this certification removed. This isn't the place. You skipped a number of chances to challenge liability. And now you're sitting here late in the game, and now you want to challenge it because you discovered that ignoring the paperwork was not going to make problems go away. In fact, just caused you a huge problem. And that's kind of where it is, right? The review is limited to whether the certification itself was erroneous, right? or whether the IRS failed to reverse it when they should have. And we're going to discover that this taxpayer is going to discover that, hey, like it or not, neither of those is going to turn out to be true. Okay. A seriously delinquent tax debt in the year in question, 2023, is an assessed, unpaid, legally enforceable federal tax liability exceeding a specified threshold, which was $59,000 in 2023. Now, so there's the first key. We have an assessed, unpaid, legally enforceable liability of $59,000. Now, the IRS has to show either a notice of levy was filed and administrative rights exhausted, lapsed, or a levy was made, right, in this case. Now, the court said, hey, IRS, we have this, right? So in essence, there was a levy already in the play, right? And the threshold. The court found the unpaid liability exceeded the $59,000, and a levy was made under 6331. Notice of intent to levy and initial FPLP levy were issued in this case. So essentially, the IRS properly followed the law, and now there's a problem. Okay. Now, they said, look, we don't have authority to review your challenge, the underlying tax liability. In the case of basically Adam A. Royce Adams, Adams A. Royce and Adams 2, Adams 1, Royce and Adams 2, I'll have 3 cases, we'll get them there. The courts also dismissed the argument that partial payments below certification warranted relief, finding it said, no, the problem here is only full satisfaction or a specific exemption, neither of which were claimed by the taxpayer, allows basically the certification to be withdrawn. And as I said, the point of 7345, which where you go to tax court to challenge the IRS when they do this, was to prevent 11th hour collateral attacks on underlying tax liabilities once passport jeopardy arises. If you let it get this far, yeah, sorry, you don't have options over there. Right? You already lost your chance to challenge liability. You lost other issues, so you need to get that liability down to 0. That's going to be your problem here. So based on the law and the undisputed facts, concluded that the certification of Mr. Pifferman as owing a seriously delinquent debt was not erroneous, and that's the only thing before the tax court here. So they granted the commissioner's motion for summary judgment, saying, yeah, there's really nothing to try here because you're not alleging anything that would be grounds for reversal. Right? In essence, you've conceded everything. You've conceded everything necessary for this to be, basically for this to be issued, and you've not shown us anything about why it should be pulled. IRS didn't do anything wrong. You've not paid it off. There's just nothing there. And you're trying to argue things that you're too late to argue. You should have argued that earlier. Now, obviously, first thing is, if you have a client in this position, understand that if you're down to having to challenge the certification under 7345E proceedings, you have to understand that there's only limited things there. Did the IRS screw up procedurally is really your whole issue. Did they blow the procedures? But you cannot challenge the underlying liability aside from saying it was not legally enforceable. If you could find some way to get out of that, fine. But if there's a legally enforceable liability that's sitting there right now, you can't go back and say, yeah, but it never should have been allowed at that number. It's like, you're too late there. It reinforces that there are very specific criteria for serious delinquent tax debt. And the problem is, once you've triggered those criteria, getting rid of it is a real problem. And I think the problem we have lots of times with taxpayers who get behind is they tend to be behind on not just taxes. They tend to be behind on other things. And, and they're just going to say, well, I don't really owe this. I'm just going to ignore it and it'll go away. And once you have the certification, it's not going away. You got a big problem here. Also remember, it's not enough to get the liability down below basically the what's going to be the passport certification. Partial payments won't reverse it. Once certification is out there, trying to just pay it down below the limit currently is not going to get the certification removed. Once you have met the cases and the number at that point when you meet all the requirements is above the limit, you have a seriously delinquent tax debt and we're in trouble. Okay, back to our the most recent case is tax law is unfair. We're going to talk about Carol S. Gawler, which is personal representative of the estate of Paul L. Klein versus United States of America. This was a case from the U.S. District Court of Nevada. It's case number 3:24-CV-00082, and it was decided on March the 18th. Now, let's talk about the background of this case. And, the case involved in this case was, timely filing of various, estate and gift tax returns. So they submitted the original return in September of 17. And then in March or April of 2020, they filed an amended return, allegedly filed an amended return. I guess you have to phrase it that way. They claim they mailed an amended return. Now, key issue here. Even though they're running very close to the statute, they didn't get certified mail. This is big, right? This is really important when you're getting this close to the statute. In this case, they were like 6 months away, less than 6 months away from the statute going away. They needed to make sure they could prove they had filed before the date in September of 2020, when this would have, been too late. Now, if the amended return was if it was received by the IRS or deemed received, which is what you could have had under the postmark rule, before September 2020, then it would have been timely. Now, what happens? You may remember March and April of 2020. You may remember that was right as COVID ramped up and the IRS sent everybody home, right? Everybody sent everybody home for the most part. And the IRS was having real trouble processing things. Things were getting backed up. And they were seriously telling people not to call the IRS, trying to find out if the return had been received or when it's going to be processed, and don't submit a second return, right? Basically, they're saying all of that was true, right? Because their directives issued in September 2020 instructed taxpayers not to file a second tax return or contact the IRS about the status of your return. Okay, so they alleged they timely mailed the return, but they didn't say how, and they obviously didn't produce the certified mail receipt. Gang, certified mail receipt would have solved the whole problem. It's really important that you do that in cases like this, right? So the IRS afterwards, back and forth a few times, eventually they informed the plaintiff the amended return was never received. And they told them that after September of 2020, after the last date they could have filed an amended return. So their claim for refund was late. And as a late claim for refund, tough luck. The court has no jurisdiction to hear your refund claim. Now, the taxpayers sued the government in district court alleging failure to process the amended return. They said, hey, the IRS warned us not to refile. That should prevent them arguing the return was untimely. Now, we've discussed before the problem we have here with refund claims. We talked about that with the ERC and the appeals process. Well, the same problem is here, right? If, in fact, you cannot show that you filed your amended return, your claim for refund, by the last date for filing it, the court has no jurisdiction to hear the case. And more importantly, only if you get the statute extended by the IRS, which would have been really fun to do at that point, formal extension, will you still keep your refund claim open, right? If the statute's running out. So that was kind of our problem. And the government moved to dismiss for lack of subject matter jurisdiction, right? The court agreed. They said, sorry, guys, I understand they told you not to contact them. And more importantly, they told you not to file a second return. But having not done certified mail in the first one, you should have filed the second return. That had been the only way to keep the statute open, because otherwise you were betting that the IRS would say they got the refund claim. And needless to say, with all the confusion around during COVID, they may very well have gotten it. but then it got lost, misplaced, whatever, in the midst of all those papers. You remember that picture of the service center room with all the, boxes of return stuff in there that got published. Was that in the Washington Post or whatever? They got it arranged so they could show it, but it wouldn't show any details. You couldn't see anything on any of the papers. So, but you remember that full room? Yeah, could have been somewhere in one of those boxes. Just that much stuff. Some things are just going to fall through the cracks. Federal district court lacks jurisdiction over untimely tax refund suits. That's citing DOM in that case, right? And the taxpayer has the burden of demonstrating they filed timely. That's one of the key things you got to demonstrate in order for your case to move forward is you had a timely filing. Clearly, to establish timely filing, you can be established by proof of actual delivery. You somehow prove the day it actually got to the IRS. That'd probably been difficult to do. If you use registered or certified mail, or use a duly designated private delivery service. Guys, the last two are realistically the only options you've got, right? You're not going to be able to get actual delivery unless you walked it in, right? That's going to be the problem. And into the right service center, too, we get into that mess. So, yeah, without question, registered or certified mail. Remember, the actual service centers were actually closed at this point, too. So there really was no place to walk it in. You had to send registered or certified mail and do that. And if you had, then the refund claim could go forward. The IRS would have to answer it, right? Or you could wait 6 months and then file in court to get it pushed. The fact that the absence of alleging that they had filed timely, right, and they had a way to prove timely filing, leaves district court without jurisdiction. Citing the Baldwin case, they said, "Hey, sorry guys, we just have no option. Life's unfair. This is unfair. I see how you came to the conclusion that you shouldn't do anything because they told you not to do anything. But under the law, it's irrelevant. Congress said it was irrelevant, right?" Okay. The court also applied and rejected equitable arguments, right? They only allege mailing without specifying the method or alleging actual delivery. They rejected the argument that timeliness was an element of the claim to be determined in a facial jurisdictional challenge. And they said, nope, you've not alleged you can show timely. You've got to do that minimally, right? You didn't do that. Can you show that? If you said you could show that, then we'd go to court, right? You could show actual delivery, or you could show, you had registered, certified mail, etc. You could make that go. By the way, don't forget that. I hear way too many tax professionals who will say suddenly, certified mail won't help a bit because they'll just allege that the claim wasn't in an envelope. And that's like, no, that's not how the law works. The IRS has the burden of proof that the claim never got to them, not simply that they've got it. Now, we have had a case a year ago where somebody dropped that claim quickly in a case. I think because they discovered the IRS produced and said, oh, no, we had this in the one that was tied to that certified mail receipt. And I think the taxpayer realized that, we had never mailed two together in this. Yeah, so they had to back off. But generally, it's very difficult for the IRS to deal with that white receipt. And in any case I've ever had, if the white receipt was there, we pretty much are done with the conversation, right? In essence, they're going to lose in court because the burden just shifted heavily to them. The court also rejected equitable estoppel based on the IRS warnings. Note the IRS never changed its position on proof of timely filing. The equitable principles generally cannot toll limitations in tax refund suits, again, citing Brockcamp, right? The problem here is they didn't get proof of timely filing. Now, I understand, don't send another one in. But see, if the first one had been filed with the proof of timely filing, it wouldn't have mattered that they, couldn't send a second one in. The IRS never told them that didn't work. And, the tax professional, well, anyway, the law doesn't allow an exception. So, we can't go equitable. And equitable recruitment also rejected due to the pleaded untimeliness of a suit. It lacked foundational jurisdiction, citing DOM case that were there. So the problem is the court concluded the estate had failed to plead the necessary jurisdictional facts to establish timely filing. However, the government's motion to dismiss the amended complaint was granted without prejudice and with leave to amend. What that means is if they can show that, your flaw is you didn't say you could prove it. If you believe you can meet the proof criteria, we told you the 3 key ways to do it. If you allege you can meet one of those criteria, then yeah, the case will probably go forward. But you haven't alleged that at this point. The key takeaways on this: filing requirements must be strictly adhered to, especially when we have refund claims. Even during crisis, timely mailing itself, even if you have actual videotape of the person putting the return in the envelope, putting the envelope in the mailbox, right? And the date and time was there. We can prove it. We got all these things. Now, I don't know how we prove all that, but let's say we did. It wouldn't be enough. Get the white receipt. First thing is way simpler doing all those other things. And second, the law says you got that, you're in. So don't worry about it. And remember, nothing changes that. Unless the IRS specifically says we're changing that rule's still there and you can't show you filed it timely. And that was the problem with their first filing. They didn't do that. And so, as I said, at that point, they really needed a second filing. Also, very strongly advise clients to use methods with proof of mailing delivery, certified and registered mail, or one of the specified designated private delivery services. And also remind them, it's not enough to use FedEx or UPS. You've got to use one of the services listed in the most recent revenue procedure offered by FedEx or UPS. If they add a new service, it won't count until we get an update and the IRS adds it to the list. We've had problems with that multiple times. So don't get into that. Be aware of jurisdictional prerequisites for tax refund suits in federal court. Even if you're not an attorney, remember the claim for refund has to be there. If we are going to sue, if we get turned down, we got to make sure we preserve the right for the suit. So be very, very careful there. And also recognize limited application of equitable arguments to total tax refund statutes limitations. We haven't yet had a challenge similar to what we've had for tax court, like we did in the Third Circuit. But I think there is a stronger case that equitable relief does not apply here. Because unlike the statutes they're talking about for the tax court, here it is very, very clear that nothing the IRS does, aside from signing the extension of the statute, can open up the statute for this purpose. And you're talking about also the deal of, being able to file a claim against the government. Those claims are limited. We have that. Okay, next up, we have Lonnie Hubbard, our individual who had his IRA taken by the government as part of his criminal case. This is from the Sixth Circuit Court of Appeals, case number 24 of 1450, came down on March 19th. So let's talk about Lonnie. Lonnie Hubbard generated income through illegal drug sales. Okay, that was part of it. And he established a SEP IRA that grew to $427,518 by 2017. And as we know, the contributions to that account are tax deferred, with the theory being when Lonnie took the funds out of the account, he'd pay tax on them. Now, he was convicted of drug offenses and money laundering offenses, right? And the government pursued criminal forfeiture of his assets, including that SEP IRA account, the IRA account that he had, right? In 2017, they seized those funds, seized the account, took the funds out. The IRS treated the seizure as a taxable distribution to Hubbard, and they issued a notice of deficiency having him pay tax on $427,518. Now, Lonnie was, I never got any of that, right? In fact, he argued the tax liability should be paid by the feds because the IRS was forfeited to them. And while the tax court didn't buy that theory, the Sixth Circuit said, wait, there are two types of criminal forfeiture. You got to be careful which one you have. This was a case where the government obtained ownership of specific property, an in rem judgment. Okay? While the other side is there a personal money judgment against the defendant, as in a personal judgment, and they need to come up with and pay X dollars. And the IRS does have the right, when they go seizing assets, or the government does fulfill that, they could seize the IRA. Which way it was done to the Sixth Circuit makes a big difference in whether it's taxable or not. The court concluded that Hubbard was the first type. Basically, the government specifically got ownership of the IRA account, right? And it became the owner of the IRA. As such, the court concluded that we'll go down the idea of income. Under 61A of the Internal Revenue Code, gross income is broadly including unlawful gains, right? And IRC Section 408D1 in the IRA area mandates any amounts paid or distributed out of any retirement plan shall be included in the gross income by the payee or distributee. Okay. And the real question is whether the IRS withdrawal from the forfeit IRA account was taxable income to Hubbard. And the real question we're going to find the court focuses on, was he the payee or the distributee? Have the issue. Now, the tax court relied on cases where involuntary IRA distributions to third parties were satisfying obligations to the owner were taxable. Garnishment for child support, tax debts. The Sixth Circuit said this isn't the same as those. There wasn't a fixed dollar liability. Lonnie could not have gotten out of this issue, by simply paying over 427 whatever thousand to the IRS from other funds. Rather, the IRS took ownership not the IRS, but the government took ownership directly of the IRA account. Right? So the forfeiture order didn't create a debt, but transferred ownership to the government. Right? They were simply seizing ill-gotten assets. And the IRA account was one of the assets that was ill-gotten. Right? When the IRS withdrew the funds, it was acting as the owner of its own property, not taking Hubbard's money to satisfy a debt of Hubbard. Right. In essence, they got the property. So that's different. Right. It was their property under the law. As their property, the Sixth Circuit said that won't be taxable. Right. So it reversed the tax court decision. When the IRA was forfeited to the IRS, the agency became the owner and controller of the funds. When they withdrew the funds, it was acting as a payee or distributee under 408D1, not Hubbard. Right? If this had just been a judgment against Hubbard, let's say for unpaid taxes of $427,000, and the IRS had gone and seized that account after that point, that would have been a distribution to Hubbard, right? Would have come down that path. Hubbard did not receive an economic benefit or discharge of indebtedness at the time of the withdrawal. That's also true, right? In essence, there was no debt. He just didn't own the asset. That's how the Sixth Circuit viewed it, right? Now, this is weird because it has a distinction between forfeiture type. Ownership transfer versus monetary judgment is crucial for tax consequences. Assuming you're representing somebody who gets in this mess, we've got that. The government becomes legal owner of the IRA through forfeiture. It is likely to pay or distribute on withdrawal, at least in the Sixth Circuit. Tax court may not agree. The discharge of indebtedness doctrine may not apply if it's a direct asset for forfeiture scenario in the government. So basically, the government simply takes the assets you got from your ill-gotten activities. They just take all assets, rather than having a specific judgment of, let's say, $2 million entered against the taxpayer, the convicted person. The courts, in this case, will focus on the plain language of the IRC, going to look at who is a payee or distributee, and they'll carefully analyze specific nature of forfeiture orders. When advising clients is really important to those of us in tax practice, especially if you're in the Sixth Circuit. Now, the problem here is you probably want to talk to legal counsel, about first thing is if you're not in the Sixth Circuit, is this still going to work here? But more importantly, we're going to talk about them, if you're here, if you're in other circuits or, if you're in the Sixth Circuit even, do we fit within this case? Because this deals with very technical details of how things are structured. And by the way, your client will never know this. They'll never really get, they'll just automatically say, oh, it's that. So no, legal counsel comes in because this is not a tax issue. We're looking at fundamentally an issue before for ownership of the asset under federal law. And that's going to determine what's going to happen on the next move. At least, as I said, in the Sixth Circuit. Next up, U.S. District Court for the Eastern District of Missouri. It has the Express Scripts Inc. and Express Scripts Holding Company versus United States. It's case number 4:21-CV00737. Decision came down on March the 18th. And we're back to the old Section 199, Domestic Production Activities Deduction, DPAD. Right? Okay, so Express Scripts was a pharmacy benefits manager. Okay, they sought a refund for 2010 through 2012 based on domestic production activity deductions under Section 199. They claimed DPAD based on receipts from claim adjudication software they had developed. Right? They argued it derives receipts from either licensing the software or providing customers access to the software for direct use. Right? And they claimed, therefore, they had significant domestic production gross receipts and qualified production activity income during those years, which led to a nice big deduction and a refund based on claiming those things. So that's where we end up with Express Scripts. Now, the court in this case, noted that previous 199 allowed deduction based on receipts from qualified domestic production gross receipts, DPGR, from the disposition of qualifying production property, which included any computer software. Now, Express Scripts are going to laser focus on the 199C computer software aspect of it and say, hey, we're clearly got computer software here, therefore this all qualifies as DPAD. Right? Now, the IRS regulation specifies that DPAD was allowed for revenues from sales, but not services. Right? And the court stated its role was to independently interpret the statute, referencing Loper Bright. Okay? Now, if you remember Loper Bright from last summer, that was when we got rid of the Chevron deference and took up this new Loper Bright. And what the court told us in Loper Bright was that we don't automatically assume a regulation is valid if the law itself is, not, is ambiguous, right? Now, by the way, if the law is not ambiguous, Chevron and Loper Bright come to the same result right away. If the law is not ambiguous and only allows one interpretation, that's the interpretation. We're done. We can all go home. So if that was the case, it was clear, then we'd be done. And it wouldn't really matter if we're looking at Loper Bright or looking at Chevron. It'd be the same result. And I've hit that multiple times with people who are like looking at this and saying, well, but the law itself says, exactly it. It's crystal clear. It's like, if it's crystal clear, then Loper Bright didn't change anything. You would have won under Chevron. No, Loper Bright only applies if it's not crystal clear. Right? And then we get to applying the rules of statutory interpretation, where the item is capable of being interpreted different ways. And if that's the case, then we look at, under Loper Bright, try to analyze, how the agency acted, what it did for the reg, and whether that is in line with, the requirements for statutory interpretation. And it also made sure that the court does independently interpret the statute. It does not, just say, hey, there was this ambiguity. Is the IRS interpretation of this one reasonable? Not is it the best interpretation, but is it reasonable? If it was, you followed it under Chevron. Now we're saying, nope, we're going to do this, but then applying the standard rules of statutory interpretations, we're going to essentially look to see whether or not this reg is valid. Is it in fact a valid reg? And in this case, they're going to pay specific attention to a separate issue that's hinted at in Loper Bright, but they didn't really go into detail. And that's what happens if Congress specifically granted the agency the right to draft the rules. In essence, Congress left things wide open, and it's up to the courts to determine, or not up to courts, but up to the agency to actually write the detailed rules. And, we're going to get down that path. How does the court deal with that in Loper Bright? And the court said, Loper Bright does not mean you ignore that, right? Loper Bright means, and I think this is where we get to the theory of respect that we were told in the Loper Bright case. We have to consider that Congress granted that right over here, right? So the court found that, the contracts did not establish that Express Script ever granted licenses or sold the software. right? Then grant license. Well, we normally don't sell software. We license it, but there was no evidence that they had ever licensed that software. The contracts that they signed with their customers specifically stated claims adjudication was a service that was going to be provided by Express Script. The plan sponsors had no direct access to the software. They couldn't use the software, right? They couldn't get directly there. And they said this is different than cases like Bloomberg, where the customers directly use the software. Submitting information to Express Scripts is not the same as having direct access to the underlying software. They're saying, and in this case, in essence, they're saying they're not really selling the software. What they're doing is they're using the software to assist them in providing a service, but they're selling a service. Right? They're selling a service, right? And they said, look, your contracts, you charge your customers fees for ingredient costs, dispensing, administration, but no charge explicitly for software or claims adjudication. There's no bundled fee was ever defined in the agreement. Because they're, that's also how they're going to divide it up. You got to figure out what are your domestic production gross receipts. And they're saying, no, we don't see that you ever transferred it. And we don't see that, there's been proper transfer or use, by the customer. And, we also say that, you never charge for that access separately. Unlike Bloomberg, who will charge for it, right? It's a little different there, okay? The court concluded the agreements designated claims adjudication as a service. It was a pure service, the claim said that. They didn't license or otherwise dispose of the software as required by Section 199 and regulations. Yes, it was software, but remember, you've got to dispose of it, right? License or otherwise dispose of the software for it to come under this, right? There were no separate fees for software, and plan sponsors did not directly access it. And the limited interaction by pharmacies and plan members was for inputting information to the for the service, or for Direct Scripts to actually then do their service, right? And the court granted the United States motion for summary judgment on the DPAD claim, finding the regulation was valid. Now, Express Scripts said, wait, Loper Bright required denying summary judgment. Now, what the court stated clearly was its determination was not limited by Loper. It said Loper does not automatically grant you the win, right? It did not affect an agency's clearly conferred rulemaking authority. Now, it does mean, therefore, we're going to give a higher level of respect here because Congress is granting this generally because the agency has more expertise in the area than Congress does. Congress is not going to write this rule. And it's explicitly granted. This is not an agency taking a statute that's unclear, and simply, clarifying it and doing that, taking it upon itself to do that. No, this is Congress ordered them to do it. They were granted explicit authority, right? So, and the court will interpret the statutes, even with agency discretion. So, if in fact they found the agency had abused its discretion, or hadn't done it properly, there are various things you could do there. But the mere fact that you don't like the way they came up with this is not by itself good enough to simply say they're wrong. In essence, the court used Loper Bright to affirm its role in interpreting 199 and related regulations, saying, yeah, we got to make the call. And we don't have to make the call like you're saying. It's, we're going to interpret it under reading the statute, considering, what exactly on the interpretation, standard rules of statutory interpretation that we're using going forward, and that's going to be the issue. So for tax practitioners, obviously, if you still have a DPAD issue there, you got to understand the distinction between sales and licensing of software and provisions of services utilizing software. There's a difference in the two, kind of how it works in each way. Do you do that? I'd say it's kind of like today. If those who've been around for quite a while, remember back in the old days when we basically had, you'd send your returns out on input forms to CCH or Fast Tax. And their computers would then, they had software that did it, their computers would process and send you back a return. But that really was just them, that you hired them to produce the return. And you use the input forms to provide them with the data. Okay? So arguably, that's not used, even though there's software in there. And even though software is obviously absolutely needed to get this working, it was done so that, Commerce Clearinghouse and Fast Tax, which I think eventually became part of Thomson Reuters and is, in all of those things these days, they would process the stuff and handle it. Now, today, you actually get the software from Thomson Reuters, Wolters Kluwer's, Intuit, whoever. That would be a different situation where we actually have the software that we've licensed and have on our own servers, or even we license it and we use it on their servers. We still have direct access to the software. We're the ones running the software. We're not simply providing data that then the other side will input, take care of, and then give back to us, right? Mere sophisticated software providing a service does not automatically qualify for DPAD as if the software were disposed of. And as I said, and keep in mind, Loper Bright's important. Loper Bright is something, but don't treat it as a magic tool, right? As I said, I've really hit too many cases where people come back and are using Loper Bright, and their only underlying argument is, well, the statute itself is not ambiguous, which is my statement has always been, if that's the case, you don't need Loper Bright. Your position would have been just fine under, Chevron. Again, that's it. It doesn't change the basic test of, is the law clear? If Congress is clear in the law, we're done. We don't need a regulation. We've got it from the law. Finally, the IRS sends out some brand new questions about the employee retention tax credit. No, you all can't wait for that, right? Our favorite credit, our favorite thing. And what they did finally was do something that we were kind of hoping, which I thought they would do, but I couldn't actually ever recommend somebody do it. Go down this path, or at least I couldn't say for sure it would work. I think that was the biggest danger. So they updated their FAQ, frequently asked questions about the employee retention credit, on their website. This is a March 20th update. And if you go to that web page, you're going to find, just search for March 20th, right? Because they always tell you when they've made changes. The March 20th update is the key. Now, remember, under the employee retention credit, right? You had to reduce the amount you can report as wage expenses in the year in which the qualified wages were paid or incurred. And also applies to capitalized wages and inventory costs. So you had to take those wages out and then make the appropriate, like if you're capitalizing wages into inventory, then yeah, you would end up then having to modify your inventory, and basically decrease your basis in that inventory. If you were using it, let's say, to build an asset, a self-constructed asset, and you were capitalizing those wages for that, then you would obviously, when you capitalize those wages, you would essentially reduce, in that case, the capitalized assets basis at that point. Okay, now the problem with this was you claimed the ERC on a 941, a payroll tax form. And for most taxpayers, you claimed it on a 941X because, remember, initially, the ERC did not apply to any taxpayer who applied for basically the payroll protection loans. The payroll protection, loans were just, if you applied for those, you couldn't get it. At the end of 2020, that was removed. You just couldn't use the same wages for both. Okay? But that meant that a lot of people had wages, right, that were now available, and they, and basically they could go back and make the claims for refunds. So now suddenly we're doing it. They also expanded expanded definition of a small employer so that you no longer had issues. They did for 2021, for when they, for what would be a small employer, where you didn't have to have people that just weren't working at all and were being paid. You could just have people who were, who were working and being paid. If you were a small employer, we went from 100 employees to 500. But the reality was, the other problem with that was, by the time they did it, and by the time people had time to actually digest it and understand it, we were generally well into 2021. And remember, it really only applied, as a credit for the first 3 quarters. So very, very few taxpayers that I've been involved with got their ERC by claiming it on a 941, the original 941 they filed. Rather, the huge proportion were done on claims for refunds, and the really big numbers started coming when the ERC mills started going big, and they put in a bunch of claims for refund. Not surprising, because the IRS has no electronic method for handling 941Xs. It got really stacked up. And yes, there were a lot of claims that were very, very interesting in that mix too. So it's just sheer volume meant that the IRS got bogged down. They didn't get them out, which was fine for your refund claim because you could claim a refund, right? The IRS, you can just wait for the IRS to act on it. And until they issue you a denial, you don't worry about your statute running out. However, the statute for filing the return to reduce your wages, right? Amending your income tax return, reducing the wages and paying the tax, that was still running. And a lot of people, the clients pushed back against amending the return and paying the tax. And a number of tax pros recommended not doing that. And as it became very clear last year that there were going to be statutes closing for income tax purposes, it was a real problem here. What happens now if you get your ERC claim paid? And at this point in time, you absolutely cannot. And I say this because I know people who have tried to do it. I do it in cases other than ERC in the past and with ERC recently, where they've tried to go back and amend that year, amend the 2020 return this late in the game in 25, and basically 2020 return that where the statute expired back in April of last year. And the IRS will just simply return basically the amended return and the check. They cannot accept that payment. So what does that do? Well, the IRS, and my own take is they waited way too long for this. It was, this problem was obvious was going to happen. We knew that when we got to the latter part of 23, right, that this was going to be a problem. We knew it when the IRS put up the moratorium, but they waited until now to actually finally do it. What they are proposing is a simpler option. So so let's start with the first issue. There are two simple ways to do a simpler option. Number one, let's say that finally you've just gotten your check for your employee retention credit. In 2025, today, you just got it today. And it was for 2020. You did not reduce wages under 2020 return, and you're no longer able to do so. What the IRS says is they can now include the ERC amount as gross income in the year it was received. Now, it also does not state, it states actually right now, if you just got your refund today for 21, your statute's still open. This simplified method certainly seems to allow you to still use the simplified method, even if the taxpayer could still amend the 21 return, at least for the next few weeks. They could do it. When we start seeing statutes close on us. Well, actually, they have closed to some extent on pass-through entities by now, but, get individual statutes, etc., so we could still do it. You can go ahead and just pick up the income, right? So here's our example with no initial wage deduction. Business A claimed $700 of ERC, 2021 wages, did not reduce 2021 wage expense. They received their payment in 24. They don't need to amend their 21 return. Rather, they would include the $700 in gross income on his 2024 income tax return. And this is really important because the statute of limitation for May original year has expired, which, again, with these facts, we don't know for sure if it did or didn't. They didn't say, but you'll do that. Now, it's based on the tax benefit rule. So IRS notes, if you can show you got no tax benefit from deducting those wages. But remember, the tax benefit rule says it did not, those wages that you didn't pay tax on, those wages that you deducted you shouldn't have, that had they not been on the return, had you done it right, that your income, basically, it wouldn't have changed your tax by $1 and it wouldn't have changed any carryovers. That's basically the tax benefit rule. Now, that's very possible, in some cases, if somebody had a lot of itemized deductions, so their taxable income went to zero that year. However, they had enough income so that it would have, we don't have an NOL. So there are ways the tax benefit rule could work in your favor in this case. So keep that in mind. In essence, it wouldn't have reduced the tax. So under the tax benefit rule, you would pick it up as income in 24 as long as there was a tax benefit to you. Like I said, there would have been a change in tax or a change in carryover. Right? So a change in carryover is coming out of 21 or a change in tax in 21. Those are your tax benefit rule tests. And you could have a partial tax benefit where, yeah, it reduces it, but let's say only for the first $350. After you get about $350 of disallowed wages, it makes no change. Then you would pick up $350, right? Again, using that same basis of at what point do we stop changing the carryovers or the tax due? Okay. Now, what about if the opposite happened, right? What if you had actually done the amended return, you paid the tax, and now you find out they've disallowed your claim? Well, that's interesting. Now, the IRS actually only covers here a fully disallowed claim. However, it appears to me without question, by their logic, that the same result should work if you have a reduced claim. So not a disallowed claim, but a reduced claim. So let's say, you had done less. So that's an analogy. It's not explicitly covered by this. But if your client, let's say, asked for $200,000 and received only $100,000, they had reduced their wage deductions by $200,000 back in 2020. And years closed now for refunds, and you had not extended the statute, at this point in time. So the statute's closed to claim a refund on 20. By the way, you could have done a protective refund claim. It's what you should have done if you did that. That was what I was telling people the safest way to do this that you knew would work is go ahead, amend the return. If I know something that will work, that is no risk, not going to say it's easy to do, not going to say it's something you want, but it's no risk, would be to amend the return, right? File your claim and immediately file the amended, return and pay the tax. And then immediately follow that up with a protective claim, stating that this, that we're going to ask for, let's say, the $200,000, the tax on the $200,000 back, or whatever amount, to the extent that some or all that $200,000 is not, eventually approved under the ERC program. As a protective claim, the service would have sat on that. And once the ERC was actually determined, they would have either, if let's say they approved the full $200,000, they would approve the claim. They would do that. You'd basically withdraw the protective claim. Or if they came with less, then you'd actually finalize the claim and say, well, you only gave us $100,000, so we're going to now basically reduce our income by $100,000 in that year and get our refund from that year. But some people didn't do that. So if you didn't, you catch a client who did add back the wages in 2020, but then got it disallowed this year, a part disallowed, you can now just deduct those wages. So assuming it works for lesser refunds, we know if you got it totally disallowed, right? So this example is reduced. Let's say you had $100,000 of qualified wages in 21, right? $70,000 ERC. To reduce your wage expense by $70,000, receive $50,000 in 24, right? And let's say that the amendment SOL had expired. It's actually probably not right with 21, but we're going to go. Let's say you receive that in 25, right? You could increase its 2024 wage expense by $20,000. $100,000 initial deduction minus $50,000 received. So you do that. This aligns with disallowed claims. Now, as I said, the actual IRS examples in there and discussion deals only with somebody who had the whole full 100,000 disallowed, which I have feeling is going to be a lot of people. But if you didn't have the full one allowed, this would seem to work by the logic of how they're handling both this and the refund, how we're doing it, right? Now, of course, it's really important to maintain thorough documentation of ERC claims, wage reductions, and refunds received. Make sure you've got that. Remember that the principle that expenses are not deductible if there's a reasonable expectation of reimbursement. That if you are still challenging, this will be key. If you're still challenging the IRS, the IRS disallowed your claim, right? Disallowed the $70,000 claim. If you're still disputing that, the statute is not closed on it and getting it done. So you're at appeals or you filed suit in federal court. you can't yet take the wage deduction because we haven't yet fully adjudicated the case, right? So you have to do that. But if in fact you just, you basically accept it, you do not file a claim for refund, you have no plans to do so, there's no reasonable chance of being reimbursed, you decide, then you go ahead and you could claim it right now, right? If the wages were capitalized, no tax benefit was received, then you have to go back and kind of redo it. Including the full ERC and income in the year of receipt might not be necessary. Reduction in basis may be appropriate in that case, or just nothing, right? Tax benefit rule. Figure out what we need to do this, right? And, and advise clients to follow this guidance and stay updated on any further IRS clarifications as we go down this. All of that is important. Well, this has been the current federal tax developments for March the 24th, not 17th, of 2025. Again, you can find me, Ed Zollers at currentfederaltaxdevelopments.com. This way you can find me and what we're going to be doing, you can ask questions. Hopefully I'll be able to respond. It's getting late in tax season, so it's becoming tougher to respond. I'll say that right now. Also, I do take a look on the discussion sites, the Connect sites for Arizona, New Jersey, Idaho, Illinois, in that case, Minnesota. Do those. So if you have any questions, you can post there. And if I see something, I'll try to respond. Otherwise, hopefully you're having a good time. We're down now. We're getting down. Next week, we will be sitting on the last day of March. We'll be ready to get into April when, the big deadline comes up. So we'll be ready for that. So hopefully you're having a good tax season. And we'll see you back here hopefully next week for more current federal tax developments.